Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining me today as we take a look, or an introductory look, at trading options. Now, for today's presentation, I'm very pleased to have Russell Rhoads with us. Russell is an instructor with the Options Institute at the Chicago Board of Options Exchange. Now, he joined the Institute about 4 years ago after after a career as an investment analyst and a trader with a variety of firms. Now, Russell's also a financial author and editor, having contributed to Technical Analysis of Stocks and Commodities magazine, as well as edited or authored several books. Now, one available is Option Spread Trading, a comprehensive guide to strategies and tactics. And just recently, he's also published Trading VIX Derivatives, Trading and Hedging Strategies Using VIX Futures, Options, and Exchange-Traded Notes. So a lot of information here. Plus, I do want to let you know that Russell instructs a graduate-level options course at the University of Chicago in Illinois. So we are very pleased to have Russell with us today. So Russell, I'm actually going to move this over to your slides. If you would simply unmute your phone, we'll get started. Thanks for joining us, Russell. Here's the ball. Take us away.
All right. Thanks a lot, Cynthia. And I appreciate the introduction as well. Yes, my name is Russell Rhoads. I'm an instructor here at the CBOE. We have an education division known as the Options Institute. And what we're going to do today, and actually through the rest of 2012, Cynthia and I have actually gotten together and plotted out what I will talk about throughout the year. We're going to run through, we're going to start at the very beginning today with an introduction to equity options, and then slowly but surely move through some beginner topics from month to month. And you know, basically it's almost sequentially. You know, if you come back 12 months from now and in December after we do the last one, you could spend your Christmas holiday of 2012 and watch starting with this webcast and then the next 11 kind of sequentially a full course on equity options, and index options will be thrown in there as well. But today we're starting out, since we're going to kind of do things in this sort of order, and we're starting out with what I actually like to refer to sometimes as Mr. Call and Mr. Put, but just an introduction from the very beginning to option contracts. Real quick, there's my, making sure I have 2012 on here. There's my disclosure statement. It says that I'm here for educational purposes only, using what I refer to as a teaching stock. It's not a real ticker for a couple of examples that I'm going to run through today. Also, it says that all the examples that I am using exclude commissions. And in addition to that, I try to keep the math as simple as possible. My goal today, over the next 45 minutes or so, is to make sure everybody understands the concepts. I don't want you to get hung up in the math at all. Just try to understand the concepts today. And the concepts we're going to run through the basics of options, the very basics of call options and put options. We're going to take a look at the two most basic option strategies, and that would be purchasing a call option if you feel like a stock is going to move higher, or purchasing a put option if you felt like a stock might be moving lower, or you're concerned that a stock might move lower. Then I'm going to, before I run through a quick summary, we're actually going to talk about the exercise and assignment process. We get a lot of questions about that, so we're going to finish up and run through the exercise and assignment process. You know, feel free, if any questions pop in your mind, to definitely send them to, I believe we're supposed to send those to all panelists so that I can see them as well. Cynthia and I will both see all of those questions, and I'll do my best to address every question that comes in over the next 45 minutes or so. If there are Interactive Broker specific questions, Cynthia may chime in and help out with platform questions. Although, and we're keeping this amongst ourselves, I've been an Interactive Brokers user for over a decade, so every once in a while, if I'm comfortable enough, I might actually try to answer a platform question if she doesn't get on quick enough to do it. So at the very beginning here, there are two types of options. We have call options and put options. and they both come with a certain right or a certain obligation depending on the position that you have with one of these options. Starting out with a call option here, if you purchase a call option, and when we say if you're an equity call buyer here, if you are purchasing a call option and initiating a new position, you have actually acquired the right to buy 100 shares of stock. A standard option contract, and that's what's down here with down here in the fine print, options typically do represent 100 shares. Every once in a while, there'll be an unusual, a non-standard option contract, but for our purposes today and for 99% of option trading purposes, we're thinking about equity options that represent 100 shares. And if you purchase a call option and open up a new position, you've actually obtained the right to buy 100 shares of stock. Now, whenever somebody purchases an option contract, there is going to be somebody on the other side of that trade, and they've actually sold you that option contract. Now, if they're selling to initiate a new position, they've actually taken on an obligation. Again, you've bought an option and you've gotten a right, and the seller of the option contract has actually taken on the obligation, and since you have the right to buy here, the seller of an option contract would actually take on the obligation to sell 100 shares of stock. On the other side of the coin here, let's say you've decided that you think a stock is going to move lower, you might actually consider buying a put option. And an equity, if you buy a put option on a stock, you've actually gotten the right to sell 100 shares of that stock. Now, somebody's on the other side of that trade, and if they've initiated a new position when they've sold that option contract, they've actually taken on an obligation to make good on that right that you've purchased, and they've taken on the obligation to buy 100 shares of stock. And we'll go through the actual exercise and assignment process after I run through a couple of examples here. But if you have the right to sell 100 shares and you choose to exercise that right, somebody that has an open short put option position in the same stock is actually going to be obligated to buy 100 shares of stock. They're going to be obligated to take the other side of the transaction that occurs when you exercise your right. Now, we're going to talk about option contracts going to expiration and standard stocks and ETF options. When I talk about equity options today, I'm going to be referring to both stock options and exchange-traded fund options. Both have a standard expiration of the third Friday of the month. In fact, this Friday is the third Friday of January, so standard option contracts expire this Friday. However, over the last year and a half or so, we've actually had what are referred to as weeklies, and now we've got about 80 stocks and exchange-traded funds that expire every Friday, and those are referred to as weekly option contracts. We'll have a list will come out tomorrow, and there'll be about 80 stocks and exchange-traded funds on that list. They'll start trading tomorrow morning, and they'll expire the following Friday, which is not the third Friday of the month. If you've heard people refer to weekly option contracts, for the most part, they are exactly the same as the standard third Friday of the month option contracts. However, they just expire on a different Friday. And the most actively option-traded series, such as IBM or very familiar names like Google or IBM, generally have weekly options that trade there. But we're going to stick with standard option contracts as well today. Just wanted to make people aware that we do have weekly options as well. Now, an option buyer, as we just mentioned in the first couple of slides there, receives a right, but they pay for that right, whether it's buying a put option or buying a call option. You pay a premium. The seller of an option contract who takes on some sort of obligation is actually paid to take on that obligation. And remember, option contracts represent 100 shares. You'll see the price quoted in a per share amount. So if you see an option contract quoted at $3, and of course this is excluding commissions, but if you see an option contract quoted at $3, the actual cost is $300, again excluding commissions. And this is what a typical option contract would look like. We would have and I'll run through each of these pieces here. XYZ here represents the underlying stock. Don't try to pull up a quote for XYZ. It's what I refer to as a teaching stock, just a a generic symbol that we use when we're doing introductory classes on options. Now January is the expiration month. You also might see that shortened to JAN. 50. 50 in this case represents the strike price or exercise price. We're looking at a call option, so this is the right to buy 100 shares of XYZ at $50 a share. Just mentioned it's a call option. It could also be a put option. If this were a put option, this would be the right to sell 100 shares of XYZ at $50 per share. Then finally, we've got that premium, or the price of that option contract. Quoted as $4.20, but again, we multiply $100 times that quoted price, or the 100 multiplier times that quoted price, and we get a premium or price of $420 for that option. So those are the basics of the basic components of an option contract. And with that, we're going to jump right into what is probably considered by a lot of individuals as maybe the first option trade they'd like to try out. A long call involves, it's a bullish strategy. We expect a stock to move up over time. We expect a stock to move up, and I'm going to overemphasize that time component there. All these option contracts have an expiration date, so when you're going to do an option trade, you definitely want to have a price outlook and a time frame that you expect that outlook to occur. One of the nice things about a long call position is your maximum loss when you put on a long option position, this can be long call or long put, is actually limited to the premium that's paid for the option contract. And we'll see this as we run through this trade. And theoretically, this is kind of stepping from the real trading world over to the academic world for just a second, but theoretically the maximum gain for a long call position could be unlimited. Theoretically a stock price can continue to rise, so theoretically the maximum gain is unlimited. In the real world, let's just say that the maximum gain can turn out to be very generous, or something, a different word than unlimited. But I believe everybody gets the point between the academic thought and the reality thought. So we're bullish. We're going to take we're going to put on a bullish trade here. We've got a bullish outlook on XYZ Corp. Again, sticking with that generic ticker symbol there. Right now, the stock is trading at $34.50. We've got two components to this trade, two components to the outlook. First off, we believe that our stock should trade to $40 a share, and then we expect this to occur. I apologize for the font there, but this should occur in the next 45 days. So this should occur by March expiration. So we've got a price target, $40 a share, and we've got a timing of that outlook of 45 days. And so then we've got that outlook, and we decide to take a look at March call options that are trading on XYZ. And here's some theoretical, some potential March contracts that we could think about, we could consider purchasing if we were going to take a long position, have a long outlook on XYZ, expect the stock to trade up to 40 by March expiration. Now, with the stock at 40 at March expiration, there'd be no value in this 40 strike call, and the 30 call's got a little bit higher premium. So the bang for the buck that you'll get if you're thinking about putting on a long position and buying a long call here actually comes from the March 35 call. March 35 call, we're going to take a long position. We're going to pay the ask for it. We're going to pay $1.25 or $125 for that option contract. And then we're going to take a look at what our potential payoff, what's the potential profit or loss here at expiration. Now, starting out, I went ahead and filled in the premium paid. When I take a look at the payoff at expiration, I always like to break out what the value of the option contract, in this case, if we're doing a spread trade and there are multiple contracts in there, I like to break them all out individually. And then I also like to I like to throw out what the premium, what the income may be, and if you sell option contracts, you get paid. But in this case, we're paying out $1.25 per share. and then we'll take a look at what is that 35 strike call worth at expiration. There's no time value left, so the 35 strike call, the value of this call option, involves the ability to exercise this call option and then turn around and sell the stock in the open market. So focus in on $40 a share here. If XYZ is trading at 40 at expiration, and we've got the right to buy the stock at 35, there's $5 of value in that option contract. Well, if there's $5 of value in that option contract and we paid $1.25 for that option contract, the net result is a profit of $3.75. And you can see at any price, 35 and lower, there's no value in that option contract. It goes out with no value, and our maximum potential loss here, again, is the premium that we paid for the option. It's $1.25 or $125. Going to the more favorable side, let's say we overshoot our target. We hit $45 a share on the underlying stock, paid $1.25 for an option contract that's worth $10. Net result here is a profit of $8.75. And in addition to taking a look at the payoff table, we also like to take a look at what is referred to as a payoff diagram. And there is our payoff diagram. We've got the March 35 call, and we'll highlight a couple of price levels here. First off, our maximum potential loss is $1.25, the premium that we paid, and that's at any price here from $35 and lower at expiration. Our break even on this trade is $36.25. We paid $1.25 for the option contract, and we've got the right to buy the stock at 35. We need to add that $1.25 of premium that we paid for the option contract to the strike price of the option contract to determine our break-even level. Right there at $36.25 is our break-even level. And then our maximum gain theoretically is unlimited. Let's just say it's substantial as the stock continues to move beyond that strike price of $35 a share. So this is a basic, long call option. We've got a bullish outlook on XYZ. We expect the stock to trade higher, and we've decided to buy an XYZ March 35 call. We chose March because our price outlook is for the stock to trade up to 40, and we've chosen March because we expect our price target to be hit at very close to or before March expiration. So now we're going to go from being bulls to being bears. We're going to take a look at buying a put option. This is basically the opposite outlook of that long call. This is a bearish strategy. We expect lower prices for the underlying stock. Again, and this is one of the key components or key pieces of knowledge relative to a long put. We actually, the maximum loss, just like with a long call, is limited to that premium that we paid for the option contract. And the maximum gain, remember the maximum gain for a long call was theoretically unlimited. The maximum gain for a long put option it's theoretically substantial. There's a couple of $2 words there. The maximum gain is based on the stock going to zero at expiration, and we'll take a look at that. I'll refresh that thought as we take a look at my bearish outlook on. We're not looking at XYZ. We're actually looking at Vroom Corp, VRM, another teaching company, not a real company. Let's say we've got VRM trading a little over 50, and we think the stock's going to trade down to 45. Now, again, we've got a price target of 45, and we expect that move to occur over a 60-day period. The timing is 60 days. Here are our choices. We can take a look at the 45 put, the 50 put, and the 55 put. Remember, our target was that 45 put, and the best use of capital would actually be buying one of those 50 strike puts and paying $2.50 for it. The premium is we're going ahead and we're paying up the offer price, and we're getting filled by buying one of the VRM 50 strike puts at $2.50. And the table works the exact same way as far as starting out and filling in the premium. We've put the premium paid, regardless of what price VRM is trading at April expiration, 60 days down the road. That premium paid is going to be subtracted from the value of one of those April 50 strike puts. Now, at expiration, at any price from 50 and higher, there's no value in the right to there's no value in the no extra value in the that right to sell a stock at $50. If the stock's down at 45 at expiration, we've got the right to sell it up at 50. We've got a $5 profit, or we've got a $5 value, which results in, let's focus in on that one right there, a $2.50 profit. If the stock trades down to 40, we've got a $7.50 profit. I'm going to back up one slide because I got a question from Grant that relates to the previous slide. And it was, why did I choose the VRM 50 strike put? Well, my target is 45, so I'm expecting an option contract to be worth the 50 strike put to be worth $5 at expiration. That would be a $2.50 profit on an option contract that I pay $2.50 for. And that's a 100% profit. If I had chosen the 45 put, at expiration, the 45 put would have no value. That actually would have been a loss of the 75 cents that we paid for that option contract. And if we had taken a look at using the 55 strike put, based on our outlook that the stock's going to be at 45, that option contract would be worth $10. So we'd have a $4.40 profit on an option that cost $5.60, which is a little bit less than a double. So as far as a use of capital goes, we chose to use the 50 strike put. So, and that outcome again would have been paying $2.50 and a profit of $2.50. Nice, clean, round numbers because we're talking about the concepts today. And we've reversed our payoff diagram, as we normally like to do. We like to chart these things out in addition to doing a table. And we're going to take a look at some of the significant levels here. Our maximum potential loss, again, at any price above 50, we have a loss of $2.50, the premium paid for that option contract. Our break even, we need the stock to be below 47.5. At 47.50. The right to sell the stock at 50 is worth $2.50. So we paid $2.50 for an option that's worth $2.50, and our break even is 47.5. And I'm using another one of those very large words there. The maximum gain is substantial. In fact, the maximum gain is actually $47.50. If the stock is at 0 at expiration, and we've got the right to sell something at 50, that's at 0. We've got $50 of value there, and we paid $2.50 for that option contract. I would say a $47.50 profit on a $2.50 investment, that qualifies as being substantial. So I've mentioned exercise a little bit, and there's actually a process that you would go through if you choose to exercise your option contract. There's also a process that occurs if a holder of an option contract chooses to exercise their option contract and you happen to have a short position, you end up being actually assigned, it's referred to as being assigned on your short position. And this is something to be aware of. Equity options are what we refer to as American style. And American style option contracts may be exercised anytime up until expiration. You may choose to exercise your option before expiration. Now, often it doesn't make a lot of economic sense for you to exercise your option contract when there's time left until expiration, and the reason being is normally there's a little bit of time value left in an option contract when we've got a few days, when we have days or weeks left until expiration. And in that case, economically you'd be better off just selling your option contract in the open market as opposed to exercising it. But at times you will see options exercised early, and if you have a short option position, you actually may be assigned on your short option position. Now, at expiration, if a contract is at least 1 cent in the money on that, and we're going to stick with the standard options today, if that contract is 1 cent in the money at expiration on that third Friday of the month, on the close of the third Friday of the month, that option contract should be exercised automatically. Now, if you own an option contract and your intent behind buying that call option was, let's just stick with a call option here, your intent was not to purchase shares, but just to try to profit from the increase in the value of that option contract, if it's a penny or two in the money at expiration, you may choose not to exercise your contract. Again, with American-style options and with equity options, you have a right, not an obligation. And if you have a long position, you have the right to not exercise that option contract at expiration. Now let's just go through, and I'm using a real stock here. If IBM was at 180, and we were long one of the February 180 calls, you could choose, you don't necessarily have to, but you could choose to exercise your option if you're long a call option, and you would end up buying 100 shares of IBM at 180 per share. Probably be a better example if I'd had IBM trading at 185 or a much higher price level. But you could choose, if your decision is that you would like to own IBM and we're at February expiration, you could exercise that option contract, and the result would be buying 100 shares of IBM at 180 per share. Let's say you're short, you're on the other side of that trade, and I was on the long side of that trade, and I chose to exercise my option contract. You could possibly be assigned on one of the February 180 calls, and the result would be selling 100 shares of IBM at 180. If you didn't own the shares, this could result in you having a short position in 100 shares of IBM. Now on the put side, we're going to take a look at a little bit better example here. Say we own one of the IBM February 190 puts. We're at expiration. We're at February expiration once again, and the stock's trading down at 185. You would want to exercise this option contract. You have the right to sell 100 shares of a stock at 190 when it's trading down at 185, and it makes economic sense to exercise this option contract. On the other side of this, if I'm short one of the February 190 puts, excuse me, I've got the obligation to buy those shares. If I'm assigned on that obligation, I'll end up buying 100 shares of IBM at 190. I'm on the bad side of this, if you think about it. Stock's down at 185, and the result is I have to and the result is buying 100 shares up at 190. So, this is an introduction, just a straight-up introduction to equity options. Always keep in mind a standard equity option contract represents 100 shares. When you purchase an option contract, and we've only talked about long option positions today, when you purchase an option contract, the risk of loss is based on, it's equal to the premium that you pay for that option contract. If you hold an option contract, you have a right. You don't necessarily have to exercise that right. You may choose to do so if it makes sense to do so. And if you have a short position in an option contract, the result is an obligation. So I'm going to go here. I'm going to show, if you're watching this as a recording or a question comes to you after the fact here, there's my my email address at the CBOE. Anything that you'd like to know about any type of option position, you can find at the CBOE's website under the Learning Center link. And we do a wide variety of classes. We're scheduling classes at this very moment. And you can check cboe.com/seminars and find out if we're going to be doing an index seminar somewhere around the country near you, or if you'd like to come to Chicago and possibly take a class at the Exchange. Also, it's out of season right now, but over the summertime and during the holiday season, we actually opened up the floor on Fridays for for guided tours during I hate to refer to it as tourist season, but when we have more people looking at maps walking around the loop than we don't, those times of year, that's generally when we also offer Friday morning tours. So if you're coming to Chicago, it seems like a long ways off right now because it's 10 degrees outside today. But if you're coming to Chicago in the summertime, thinking about coming to Chicago in the summertime, feel free to check the CBOE's website, and maybe you can see open outcry trading, or what's left of open outcry trading, in action. So with that, I did have one question from Vladimir I wanted to take. It came in a long time ago, so I've been thinking about it while I've been speaking. But Vladimir is asking about stop losses and how to close combo option trades as well. I'm not 100% certain if I'm going to discuss this from the stop loss side. If your question relates to the Interactive Brokers platform, I'm going to definitely defer to Cynthia on that one. But as far as on the placing of stop losses for option spreads, you can base a stop loss on what's going on in the option prices, but you can also base a stop loss on what's going on in the underlying market or underlying stock. And I tend to lean toward the second one there. Sometimes due to implied volatility changes or other changes in the marketplace, you may end up getting stopped out of an option position that you had initiated based on an outlook for the underlying market. I tend to, and if I'm doing an option trade, or I'm discussing how to go about putting on option trades with individuals, I often, I start out with what's your price outlook and what's the time frame of that price outlook. That price outlook for the underlying should also, dictate whether or not you believe that the position that you've put on happens to be right or happens to be wrong. So instead of placing actual stop losses, I tend to like to, and I know IB is a great platform for this. I tend to set alarms for the stocks that I have option trades on, and then take a look at what the options are doing if certain significant stock price levels are hit. So that's I actually like to focus in more on stops based on what the underlying stock is doing or underlying market is doing, as opposed to stops based on the option prices. Billy is asking. He says he's interested in credit spreads. And I'm gonna multitask. It's nothing like trying to talk and pull up a file at the same time, but he's asking about credit spreads, which are vertical spreads, and I'm going to see if I can pull up a potential schedule that I have of, there we go, March, April, and May. I'm going to talk about bullish, bearish, and neutral spreads. And Billy tend to use, he's asking about credit spreads, tend to use vertical credit spreads when I talk about bullish, bearish, and neutral spreads. Next month I actually have down talking about short option strategies, and I'm actually going to talk about a debit spread, but I'm going to talk about a vertical spread in that presentation. And I know that for a fact because I just finished that presentation. So. Vladimir says thank you, so you're welcome on that. Cynthia, are you seeing any? Oh, and Lewis said, did I understand that Russell gives an option seminar every month? That is the, normally Cynthia and I chat before the presentation starts. We didn't get a chance to chat today, but the idea, at least that we were working with, was that that we were going to do one of these a month, and we were actually going to work from introduction to options and then work up to more intermediate strategies by the end of the year. That's the plan. And I've been doing monthly webcasts with one exception with Interactive Brokers for, I believe, over a year now. It seems like just about every month. And typically we like to do these during expiration week. That way we kind of know what week is in the books. So.
And I was going to jump in because, Russell, you've been very consistent on that. We do try and schedule those webinars for the Wednesday of expiration week each month. So if we're headed up to the expiry, simply remember to check out IB's website. You can either register ahead of time or simply that day, if you've got access to the information or if you've got some time, care to join us during lunch, simply open up our webinars link and you'll find a direct link to today's or to that day's webinar. By the way, all of these webinars use the same password. It will be IB Trading in all lowercase. So I just want to plug all of these events throughout the rest of the year. But thank you for looking up those credit spreads. I knew they were on the list, Russell. You're definitely much more organized than I am. I would like to also address Vladimir's question as well. Now, back on the IB platform, and we are going to be talking about some credit spreads, but there were a couple of things that Russell brought up today that I'd also like to point out for you. So, Russell, I've grabbed the ball. And what I'm going to do is quickly share my desktop. Now, what I did do is I actually have the website up because Russell brought up a very interesting concept with entering that stop loss and pegging it to the actual underlying contract. You can read more about that type of trade because we do have it available. Simply go to our trading menu. Notice here there's an order types and algo selection. Now, you'll notice the very first section, if it's expanded, you can collapse it simply by clicking through or clicking on that arrowhead. But notice here that the type of order that I did want to mention is a pegged to stock order. So whether you access it from this menu or our order types and algos in detail, you'll actually, that hyperlink will bring you through to a page where that particular order type is described. You'll see a description on the page, but also now notice down below how we've had our graphics department actually walk you through all of the various steps. Notice here, 1, 2, 3, 4, 5, and 6, actually even 7, on how to create that order and then transmit it. Now you'll see here each of the different steps are listed, but also notice the buttons here so that you can follow through what would happen to that trade as the market actually moves. So notice here there are some additional fields that you may want to activate, and notice that those will be listed both on our graphical representation, but also at the top of this page, there's a user guide. Now, the user guide is an expanded description of that order type. So if you are looking for not only Vladimir, but others as well, notice that you can try this out, even try it out in your paper account ahead of time. Now, here are the instructions and all of the different steps. Do be aware that there are certain fields that you'll need to activate, and it is going to be described in the instructions that are included here. So a field such as delta, which will actually be used to calculate the change in price for the underlying, as well as a stock reference price. Now, based on not only can you enter that stock reference price, but you can also identify an optional high or low for that price, where if the stock moves outside of that range, it will actually send a cancellation request for your order. So please take a closer look at our peg to stock order type. Now also, Vladimir was asking, when you enter into combo spreads, now combos can be made, and I do want to plug a webinar that I'll be doing next Tuesday on the 24th on spread and option trading. But notice that you can create spreads from within your option trader using the button that's available on the toolbar, or also we've just added a new combo creation. Now notice I'm going to go in very quickly and create a spread. Within our option trader, you'll see the option chains are organized according to expiration date and then also by strike price. Well, what I'm going to do is simply come down and notice here if I select a stock, or I'm sorry, an option, I can simply add that and notice how it's added to my combo screen. Now I'll also create another one by simply clicking on that option contract. Well, notice what I've just entered here, the two different, these are Feb expirations for the 20 and 21 strike price. And I've got them both on calls, or I could create a put spread the same way over on the right-hand side of the screen. Now you'll notice that profit diagram that Russell had referred to earlier as well. As you build that combo, it will actually be created. But also notice here that the action is set up automatically when you go in to create that spread. Now I've created a debit spread, but notice here I can simply choose reverse, and here's a credit spread. Now notice whichever way you choose to enter that information, notice here how it will be displayed on your screen. Now I'm going to go ahead and transmit this, and you'll see that what happened here was I created a combo spread. And I forgot to do one item here. Let's go back, and I'm going to choose the 20 and the 21 strike. What I didn't show you is the ability to add this to your quote panel. Now notice, once created here, what will appear in your interactive quote panel at the top of your screen is an implied quote pricing line. Now here is where you can either purchase the spread by clicking the, oh, it looks like I seem to have an extra window here actually displayed. Okay. Oh, well, what just happened was I did create that spread. It was a credit spread, and notice how it's appearing here. Now, the implied quote pricing line for that spread is actually displayed in the quote panel where you can initiate a buy or a sell. Now, since I did write that spread, notice here I can simply right-click and choose to create an opposite side order, or simply go in and create that order myself. Now notice when you do go to transmit to exit that trade, as soon as the price does reach that level, we'll be able to exit the spread the same way that we entered it. And you'll notice here my position has now been flattened to 0. So a quick way, Vladimir, where you can create and transmit those spreads directly within the option trader screen. Now, I do want to also bring you back to our website, and let me go to the home page, because notice on here there is an education menu with the webinars link. Now, this link here, if you do happen to click through and go to live webinars, notice at the bottom, I'm sorry, I should just click through. I actually need to click on the education menu and then go into, and here is where you can find the upcoming webinars. So notice, if it's still within the same hour as the event, you'll actually get a direct link to join that webinar. Remember, our password is IB Trading, all lowercase. But also, let's go back up, because on this menu, if I do go into the webinars link, you can actually go into the previously recorded webinars. Now, all of the ones that Russell has been doing for us will be listed underneath the industry-sponsored page. And notice here that you can choose to filter. We display all of them available, or you can simply choose to go in by exchange partner. And notice that as soon as I do, all of those CBOE events with Russell actually do appear. Now, notice you can even filter by speaker, and we'll simply go down and choose Russell's name. And here we have Russell. Oh, it looks like we've got you listed twice. Well, I'll actually have to, glad I found that, Russell. We'll make that correction today. But notice, if you do happen to pick it up, I will be putting all of those under a single entry for Russell. So a good way where you can come back and review any of the concepts that Russell has brought to us. By the way, also notice that on all of our webinar archives and on today's recording, we do include access to those slides that were used for the presentation. Notice they're included as a webinar notes link. For example, here's we have one. I'll simply click through that link, and notice the same slides that appear during the event are actually available in a PDF format where you can print and review or print those slides, or actually listen and review as Russell goes through any of those previous webinar topics. So a quick word how to access that information as well from our website. So what I'm going to do actually is take us back over into the main event window. Hopefully you've been watching that chat panel. Russell, any additional questions have come in?
I haven't seen any, no, nothing to speak about in front of everybody. Somebody was asking me a personal question if I knew somebody, but I'm not seeing any questions regarding options or nothing that I missed out on when we were going through. No.
Okay. Well, I'm not seeing any additional questions as well. So, Russell, thank you very much for today's presentation. I also want to extend a great deal of thanks to the team at the CBOE for making today's presentation possible. It's their dedication to education that is actually bringing you events such as this. So I do have one more bit of business before we do exit today, and notice that I'm going to open up a polling panel on your screen. IB's management has asked in each of the events that we do get some of your feedback to make sure that the information being presented is what you've expected. Now notice as well there is an input field for any comments or suggestions on upcoming webinars. If you do have that, or if you do have some thoughts there, please just enter that into that input field. But the poll is going to end in about 12 seconds, so if it is a little too quick for you, please keep in mind you can always send any comments or suggestions to me at webinars@interactivebrokers.com. So thanks, everyone. Please click that submit button so that I can compile your results. Thank you all very much. And I'm not seeing any additional questions come in. So, Russell, thank you once again. And we'll let you go for now, but we'll be looking for you next month, same time, Wednesday ahead of Expiration Friday, for the next in our series of Becoming Acquainted with Options. So thank you very much, and thanks to all who have participated here today. You can exit the event simply using the X in the upper right-hand corner of the screen. And by the way, remember that you can also view the PDF copy of today's slides, view, print, or save as you drop off the event. So thanks all. Have a great afternoon, and remember to trade smart.